Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to deal with the standard IAS 12, which talks about income taxes, okay? We are going to deal with IAS 12 income taxes so that we'll be able to deal with income taxes and any other item related to tax in the financial statements. Now, we are going to deal with tax, and afterwards I'm going to talk about published account. But it's important that we deal with this standard because you cannot do accounts for publication very well if you don't know how to treat tax, especially deferred taxes and other things, and how to go about estimating the tax expense to be recognized. And so I'm not going to take too much of your time with this standard. I'm going to go straight to the point, to the things that I want to pick out, and then make sure that the understanding that I want you to achieve is achieved, so that you'll be able to understand this standard as well as be able to solve questions on published accounts, which I'm going to do in my next video. All right. Before we begin with the income tax, now IAS 12, let us first of all look at the scope, okay? The objective, the scope. Now, listen very carefully. The standard IAS 12 is a standard that prescribes the treatment of taxes, being it current taxes and deferred taxes, okay? And it only not focuses on the current tax that is payable, but also focuses on future taxes that is either payable or recoverable in the future, which we call deferred taxes. I'm going to hammer on some terms that I believe you should understand as far as this standard is concerned, so that it will help us in our journey of income taxes. So the first concept that you should understand when it comes to income tax is tax base. Tax base. Now, these are key definitions that I'm going to mention. Key definitions. And the first one is the tax base of an asset. Now, when we talk about tax base of an asset or liability, we are talking about the amount that has been attributed to the asset or liability for the purpose of tax. Okay, so for tax purposes, the revenue authority in Ghana, we call them the Ghana Revenue Authority, or it could be any tax agency in your country. Now, what we are trying to say is that, let me make it practical for you. If I have, let's say, motor vehicle in my books, okay, the net book value of the motor vehicle can be 1,500. Okay, so this is the net book value that I know. When the revenue authorities also want to assess my tax, okay, for the period using my assets and liabilities, they are also going to look at it and say that, okay, to them, they think that 1,500 is either more or low in comparison to what they see the asset to be, or in terms of the value they will assign to the asset. So they can decide to say that, okay, 1,000 Ghana cedis or 1,200 is the value of the assets. So whilst we are saying the value of our asset is 1,500, the tax authority comes and say that to them, they see that for tax purposes, they are assigning 1,200 to the asset. And so this 1,200 they have assigned to the asset is called a tax base. Okay, a tax base. So the tax base of an asset or liability could be a liability. We can still assign value to our liability. The authorities will come for tax purposes and assign a different value. It could be a bigger value than our own net book value, and it could be a smaller value. But what we are trying to say is that the tax base of an asset or liability is the value that has been assigned to the asset or liability for tax purposes. That is what we are trying to say. We are not doing taxation here. We are not going to go into how they estimate tax. This is financial reporting. What we are trying to say is that the value that the revenue authority will assign, as simply as that, to the asset for the purpose of calculating tax or estimating tax, whether current or future taxes or whatever, is called the tax base. It could be a liability. So that is the first definition you should understand, that the tax base of an asset or liability is the value that has been assigned to the asset for the purpose of tax. And when that has sunk in, then we move on to the next point. I want to use the definitions so that when we understand the principles, when we take a question and we are solving, it becomes quite easier because we have the concepts in us. Having understood tax base, then let us look at what we call temporary difference. And I will explain to you why it is temporary and not permanent. Now, we just explained the fact that The net book value of the motor vehicle is 1,500, but the revenue authority has assigned 1,200 as its tax base. So if you look at the two, there is a difference of 300. This difference of 300 is what we call the temporary difference. So the temporary difference is the difference between the carrying amount. The net book value is also called the carrying amount, remember. So the difference between the carrying amount of an asset and its tax base is the temporary difference. So that is all about temporary difference. So once they assign their tax base, I told you that the tax base could be higher or lower than the carrying amount of the asset. But once we find the difference, whether it is higher or lower, the difference is called the temporary difference. So when you hear the word temporary difference, the temporary difference of an asset or liability is the difference between its carrying amount and its tax base. And the tax base, we know, is the value that has been assigned by the revenue authorities for the purpose of estimating tax. So that is a temporary difference. And it is this temporary difference that is going to give birth to deferred taxes. Okay, so we are going to go into deferred taxes. But for now, we know that the difference between the carrying amount or the net book value and the tax base of an asset or liability is called a temporary difference. That is what you should understand. Now that we have understood temporary differences, let us also look at taxable temporary differences and deductible temporary differences. We have two types of the temporary difference. We have the taxable temporary difference and we have the deductible temporary difference. So we'll say, under that we'll say taxable temporary difference. Now, I'm going to explain the temporary, please, I'm coming, and then deductible temporary difference. Now, the reason why we call it a temporary difference and not a permanent difference is that it could be recovered. Okay, they are saying that the tax base is 1,002. We are not agreeing with that. We still maintain our carrying amount. So in the future, we may recover the difference by either they coming to terms and now accepting the fact that truly they had undervalued our assets and that is supposed to be 1,005. When that happens, we have recovered it, the difference. Or, so once there could be a recovery, we fight towards a recovery. Okay, and because a recovery is possible, that is why we call it a temporary difference. It is not a permanent difference. If it is a permanent difference, we would have called it a fair value, a new fair value, and written off the difference. But we are still going to maintain the 1,005 in our books because there is not a new fair value of the asset. It is just the mindset, it is just what the revenue authority thinks should be. But we are not agreeing with that. And therefore, the difference can never be a permanent difference. If it was a permanent difference, we would have written it off from our books. So even after the tax base and after the tax, whatever liabilities and assets, whatever has been estimated, we still maintain the carrying amount as 1,500 because we are hopeful that we can recover the difference. And that is why we call it a temporary difference. Now, I have said that we have a taxable temporary difference and we have a deductible temporary difference. And I'm going to explain, starting with the taxable temporary difference. So the taxable temporary differences are temporary differences that will result in taxable amount in future period in determining taxable profits. Okay, they are temporary differences that will result in taxable amount in future period when we are determining taxable profit. When the carrying amount of the asset or liability is recovered. Okay, so when the taxable temporary differences are likely to result in taxable amount in future period. That is the meaning. Okay, and the deductible temporary differences are temporary differences that are likely to result in amounts that are deductible for tax purposes in the future. Okay, so if there is a temporary difference that will create a tax for us in the future, a tax, then it means it's a taxable temporary difference. And if there is a temporary difference that is also going to create a deductible amount for estimating tax in the near future, we call that a deductible temporary difference. So let us just play with them for now. They are not so much important, even though they are important. But we are going to look at how to consider the temporary difference in the calculation of deferred tax as we move on. Okay, so the key word here is the temporary difference. And let us try and understand the taxable temporary difference as temporary differences that are going to result in future taxable amounts in determining future profits or loss. And the deductible is also going to likely to result in a deductible amount in estimating future taxes. All right. Now let us also look at the concept of deferred tax. Now, deferred tax. Now, deferred tax, okay, Deferred tax is simple. Let me make it practical. You see that the carrying amount of this asset is 1,500. The tax base is 1,200. So we have a temporary difference of 300. So when we apply, let's assume that we have a corporate tax rate of 20%. So 20% is the corporate tax rate. So when you apply 20% on the temporary difference of 300, it's going to give you 60. This 60 is a deferred tax. So deferred tax is a tax that is arising when the tax rate is applied on the temporary difference. So take note. And we call it deferred tax because they are taxes that are likely to be paid or recovered in the future. Now, deferred tax is in two forms. We have a deferred tax assets and deferred tax liability. So deferred tax could result in an asset or liability. And this is how it's going to be. When the carrying amount or the net book value is more than the tax base, okay, the difference, when you apply the tax rate on the difference, it becomes a deferred tax liability. So in this case, this 60 will be a deferred tax liability because the carrying amount is exceeding the tax base. However, assuming we had the tax base of 1,800 or 1,900, that is going to give us a temporary difference of 400. But this temporary difference shows a positive, shows that the tax base is more than the carrying amount. And so 20% of this 400 would have been 80. And this 80 cedis would have been a deferred tax asset. So this is a deferred tax liability. The 80 is an asset. So please, anytime your carrying amount exceeds the tax base, the difference will be a liability. And let me explain why it will be a liability. You see, we are saying that our assets value is 1,005. And so assess tax based on it. You have rather reduced it. So if you have reduced it, naturally it means we are paying less tax because we have a small amount on our asset. So if we are paying less tax, in future, if it is recovered and up to that 1,005, then we still have to pay tax in future on that. And that is the word deferred. Deferred means a tax that will be paid in a future period. And so if the carrying amount of the asset is more than the tax base, then it means that the difference, when we apply the tax rate on it, will result in a deferred tax liability. Because in future, when the full 300 is recovered, they will still come back to us for tax on that. However, if they rather overstate it, 1,900, and we rather say it should be lesser than that, the 400, they are going to charge tax based on this 1,009. Okay, so we feel like they are cheating us. And so when in future we are able to recover the 400, the recovery means that they will now agree and reduce it to 1,500. Then that 500 will be a tax credit for the business. So that 400 cedis, whatever tax on it, which is the 80, will be a tax asset, meaning that we are going to gain. And it's going to be deducted from future tax that we are going to pay. All right. So please get this understanding that when the net book value of the asset exceeds the tax base, it results in a deferred tax liability. But when the tax base is more than the net book value or the carrying amount, then it results in a deferred tax asset. So please, that is it. So a deferred tax liability is a liability that is resulting from an excess of carrying amount over the tax base. All right. So that is what you should note for that, because we are now going to solve a question. All right. These are just explanations, and I feel some of them look abstract until we look at a practical question. So we are going to look at the first practical question. And in this standard, the main focus is on the deferred tax and then how to find the current tax and the tax expense for the year. And so the focus is mostly on deferred tax. That is why I mentioned that these things in theory can be important, but in practicals, we are not going to pay too much attention to that. We are going to actually understand how to look at the tax base and the temporary difference itself. And there may be how to calculate the deferred tax asset and liabilities. When we are okay with the deferred tax asset and liabilities, then we'll look for the measurement of tax in our financial statement, and we'll be able to calculate how to find the tax expense to be included in the statement of profit or loss. So let us take a question that involves deferred tax and let us solve it together. All right. Let us take this question together and then solve it. Okay. Kofi Adom Limited has the following assets and liabilities recorded in its financial statement as at 31st December 2018. So we have property, plant, and equipment. If we have each of them at their carrying value as well as their tax base. So PPE 40,000 for the carrying value, tax base is 25,000. Then inventory is 10,000 at carrying value, tax base is 14,000. Then trade receivables is 6,000, tax base is 8,000. Trade payables 16,000, tax base is 16,000. So there is no temporary difference on that one. And then cash, of course, there cannot be temporary difference on cash, 5,000 each. Then we continue reading. Kofi Adom Limited had made an allowance for inventory obsolescence of 4,000. That is not allowable for tax purposes until the inventory is sold. It has also made an impairment charge against trade receivables of 2,000 Ghana cedis. That will not be allowed in the current year for tax purposes, but will be allowed in the future. The rate at which income tax liability is calculated is 30%. Calculate the deferred tax provision as at 31st December 2018. So this is the question, okay? We have been given list of balances at their carrying values and their tax basis for the assets and liabilities of Kofi Adom Limited. And then we have been given some information. Now take note, if you look at the other information that was given, they are not different from, the additional information is not different from what you have on the balances. It's only an explanation of the balances. For example, if you look at the inventory, the carrying amount is 10,000, the tax base is 4,000. Additional information says Kofi Adom Limited has made an allowance for an inventory obsolescence of 4,000. So you see, this was not allowable for tax purposes. So what we are trying to say is that the reason why they have 10,000 as carrying value is that they have written off 4,000, but the revenue authority is saying no, we will not accept that. So they have included that 4,000 for tax purposes, and that is why the tax base is 14,000 and the inventory is 10,000. So that is nothing more to add. It's only explaining what you have. If you look at the other one, we are told also that it has also made an impairment charge against trade receivables of 2,000. That will not be allowed. That will not be allowed in the current year for tax purposes, but will be allowed in the future. So if you look at the trade receivables of Kofi Adom, it's 6,000 at the carrying amount, but the tax base is increased by the 2,000, which is 8,000, meaning that they have not allowed for that impairment loss. That is why the tax base is higher than the carrying amount. So there are a lot of things that cause the tax base to be different from the carrying amount. All right. And so we are told that the rate of tax is 30%. Calculate deferred tax. So what you need to do is to first of all find the temporary difference before you find the deferred tax. And if the temporary difference, you realize that the tax base total is more than that of the, if the tax base is more than that of the carrying amount, then whatever deferred tax you have will be an asset. But if the carrying amount is more than the tax base, then the deferred tax will be a deferred tax liability. So some of you are confused as to why sometimes you see deferred tax under current asset or maybe non-current asset, and at the same time you see it under liabilities. It depends on the temporary difference. If the temporary difference is such that there was an excess of the tax base over the carrying amount, then it results in an asset. And the other way is true for liability. So now listen, we are not going to find, if you look at it, each of them, many of them have temporary differences. PPE has a temporary difference of 15,000. Inventory has a temporary difference of 4,000 and all that. But we are not going to do it individually. We are going to do them together because it's one company and we'll calculate the deferred tax for them. So this is how you approach this question. You leave a space for the narration. You say carrying amount and then tax base. You leave a space for the tax base. This is how to present it. And then you create a space for temporary difference. And then you start with the assets. So you see property, plant, and equipment. Now, the carrying value for the property, plant, and equipment is 40,000. And then the tax base is 25,000. So if you compare, the temporary difference will be 15,000. So this is how it's supposed to be. And then the next one is for inventory. So for inventory, the carrying amount is 10,000. Tax base is 14,000. So the temporary difference will rather be 4,000, which is a negative. I'll put it in bracket because the tax base, when the tax base is greater than the carrying amount, it has an effect of becoming an asset. And the tax asset is a tax credit usually. So I put that in bracket. The temporary difference will be in bracket. And then the next item we have is trade receivables. So we do for all the assets and liabilities together. Trade receivables, 6,000 for carrying amount, 8,000 for tax base. So the temporary difference, if you compare, is 2,000. So you put the 2,000 in bracket as well. Now, the trade payables is next. Trade payables is 16,000 for carrying amount and the same 16,000 for tax base. So there is no temporary difference on the trade payables, as well as the cash. The cash is also 5,000 for both carrying amount and the tax base, giving us no temporary difference. So having done with that, you just find the total. These totals are even not important, but you can still show them anyway. The most important total is that of the temporary difference, because that is what we need to calculate our deferred tax, whether it's an asset or liability. We will know after we find the difference. And so the total for the carrying amount column can be shown, that of the tax base can be shown. But let us look at the temporary difference. 15,000 minus 4,000 minus 2,000. That is going to give us 9,000 Ghana cedis. 9,000. So the temporary difference is 9,000, and it's going to result in the deferred tax liability because if you find the total, you see that the total of the carrying amount exceeds that of the tax base, and the difference of 9,000 will result in a deferred tax liability. Now, according to the question, the rate is 30%, and therefore you see that your deferred tax liability equals to 30% of 9,000 Ghana cedis. And that is going to give us 2,700. So ladies and gentlemen, this is our deferred tax liability. The requirement was that we should calculate the deferred tax liability for Kofi Adom Company Limited. And that is how to go about it. Assuming that the negatives, which is the negatives, the brackets were more than the positive, then the final answer would have been in bracket. And when we apply on that, the final answer would have been a deferred tax asset and not a deferred tax liability. So this is how to go by the deferred tax principle. I'm sure it's very understandable. Then, having understood this, I want us to take another question again. Another question on this to enhance our understanding before I move on to one of the most important aspects of the deferred tax, which is the measurement of tax expense in the statement of profit or loss. That is very, very important. So I'm going to first take another question on how to calculate the deferred tax. And then from there, I'll move on to one very important area which we need in the estimation of tax expense for published accounts. All right. All right, let us also take this question again on how to calculate deferred tax. Afterwards, we are going to look at the measurement of deferred tax and of the current tax, as well as the tax expense, how to estimate that. So let us look at how to calculate deferred tax again from this question. Budget Master Limited has revalued its property and has recognized the increase in the revaluation in its financial statements. The current value of the property was 4 million and the revalued amount was 5 million Ghana cedis. The tax base of the property was 3 million Ghana cedis. In this country, the tax rate applicable to profits is 35%, and the tax rate applicable to profit made on the sale of property is 30%. If the revaluation took place at the end of the financial year, calculate the deferred tax liability on the property as of that date. All right, so this is a very simple question. When you meet a question like this, you just have to know the variables to pick. First of all, we are told that it is property. Okay, So property for the company. And there is an original carrying amount of 4 million Ghana cedis. And then there was a revaluation. So the new fair value is 5 million Ghana cedis. And then we are also told from the question that the tax base is 3 million. So the question is, we need to find our temporary difference. How do we find a temporary difference? Are we comparing the old carrying amount with the tax base or the fair value? The answer is that we need to use the fair value because we are told the fair value was done at the end of the year. And therefore, this is the new value of the asset in the books. And this is an old value. So when we compare 5 million to 3 million, we are going to get a temporary difference of 2 million. However, if you have compared the 4 million, you would have gotten a temporary difference of 1 million. And that would have been a disaster because you need to rather compare. So anytime there is a fair value, ignore the original carrying amount and compare the fair value rather with the tax base in order to ascertain the temporary difference. All right. Now that we have ascertained the temporary difference to be 2 million, let us go back to the question and look at one more trick that we need to pay attention to. We are told that in this country, the tax rate applicable to profit is 35%, and the tax rate applicable to profit made on the sale of property is 30%. If the revaluation took place at the financial year end, calculate the deferred tax liability. All right, so we are given two rates. First, we have general profit rate. The rate made that is applicable on general profit to be 35%. And then we have the rate for profits made on sale of property. So when you sell your property, the rate that is applicable for tax on the profit is 30%. So the question now is, which of these rates are we using to calculate the deferred tax on the property? Is it the general profit rate or the rate that is applicable to profits made from property? My answer is that we are going to use the rate applicable to sale of the property because the profit rate is different. We are dealing with property actually, so we need to use the property that is the rate that is related to property. If the question had not provided the rate of the property, then we have no choice but to use the general profit rate. But however, because it has given us the rate on the sale of property, then we need to use these rates rather. And so having understood the main ingredients in the question, let us solve it. And so let's find the temporary difference by, first of all, writing the fair value amount to be, so let me show my currency sign. So 5 million. And then the tax base. According to the question, the tax base is 3 million. So the 2 million will be the temporary difference. Now we have the temporary difference to be 2 million. So we apply the rate of 30% on that. So since the fair value is greater than the tax base, the difference will be a liability. So I will say deferred tax liability is going to be 30% of 2 million Ghana cedis. And that is going to give us 0.6 million. Or you can say 600,000 Ghana cedis. So this is how to calculate deferred tax. So ladies and gentlemen, I'm sure that this video has really helped you in understanding how to calculate deferred tax, whether it being liability or an asset. If this would have been greater, the difference would have been called an asset. As simple as that. So that is the objective of the part one of this video. In the next part, which is more importantly, we are going to learn how to do measurement of deferred taxes, as well as how to estimate the tax expense to be included in the statement of profit or loss. Very, very important. Okay, and so let us end it here so that we'll deal with the more serious point in preparing the financial statement. Over here, we have just learned how to calculate. We are going to deal with how to apply them on the financial statement in our next video. Remember to subscribe to this channel if it is your first time. Share this video. Invite your friends to also have a benefit. Together we shall grow and be successful. Until we meet again for the part two, it is bye for now.